The 30-year mortgage might be the most profitable financial product ever created. Not for you, for the bank. And it's structured so ownership arrives late, after decades of payments. This isn't conspiracy, it's business. A clean legal way to monetize your most productive years, wrapped in the language of the American dream. Before the 1930s, buying a home required serious capital. Down payments ranged from 40 to 50% of the purchase price. Loan terms were short, 3 to 5 years, and at the end, you faced a balloon payment. The entire remaining balance due at once. If you couldn't pay, you lost the house. Only financially strong households could navigate this. It wasn't a mass-market product, it was restricted access by design. But banks wanted expansion. More loans meant more profit, and the existing structure limited their customer base. Then came the Great Depression. Foreclosures spiked, the housing market collapsed. The government intervened, and the Federal Housing Administration helped standardize a new model. Longer terms, lower down payments, predictable monthly installments. This wasn't villainous, it was pragmatic. Extending the timeline made homeownership accessible to a much larger population. Families who couldn't save $20,000 in cash could now afford a $150 monthly payment. The barrier dropped, participation soared. But here's what also happened. Expanding time expanded profit potential. A loan that runs 30 years instead of 5 generates far more interest revenue. The FHA didn't just create access, it created a revenue model that rewarded patience on the lender's side and required endurance on the borrower's. This became the default structure, not because it optimized wealth building for families, but because it balanced risk and return for lenders while remaining digestible for borrowers. The house didn't change, the timeline did, and with it, the total cost.
Let's use a single example to illustrate how this plays out in practice. $400,000 home purchase at 7% interest, fixed rate. 30-year mortgage. Monthly payment, $2,661. Total amount paid, $958,000. Total interest paid, $558,000. 15-year mortgage. Monthly payment, $3,595. Total amount paid, $647,000. Total interest paid, $247,000. 10-year mortgage. Monthly payment, $4,646. Total amount paid, $557,000. Total interest paid, $157,000. Now look at the first 5 years. On the 30-year plan, you'll pay roughly $159,000 over 60 months. Of that, only about $41,000 reduces principal. The other $118,000 goes to interest, your 26% toward ownership measured in equity. On the 15-year plan, that same 5 years costs $216,000, but now $98,000 goes toward principal. You're 24.5% of the way through the loan by equity. On the 10-year plan, 5 years costs $279,000. Principal reduction, $176,000. You're halfway done. Same house, same rate, radically different outcomes. The gap between the 30-year and 10-year mortgage is roughly $400,000. That's not a rounding error. That's another house. That's retirement. That's your children's education without loans. That's the difference between financial constraint and financial options. And here's the structural reality. The 30-year mortgage front-loads the lender's return. In year 1, over 87% of your payment is interest. By year 10, it's still about 75%. The equity curve doesn't flatten in your favor until you're past the halfway point, 15 years in. Most borrowers never get there. The math isn't hidden, it's disclosed, but disclosure isn't comprehension. The monthly payment looks reasonable, so the total cost gets ignored, and that's exactly how the system sustains itself. And that's just the financial cost.
Most people never complete the full term. The average American homeowner moves approximately every 7 years. Some relocate for work, some upsize, some downsize. Life changes, and the house changes with it. When you sell, the lender gets paid in full from the sale proceeds. You move on, you buy again, and the amortization schedule resets. Your new loan starts from year one, which means you're back in the interest-heavy phase. The first decade of payments, where equity grows slowly and the lender's take is maximized. If you refinance instead of selling, the same reset occurs. Lower rate, fresh timeline, same structural bias. Time becomes a loop. You're perpetually in the early years of a long-term loan, even if you've been making mortgage payments for 15 or 20 years across multiple properties. This isn't accidental. The 30-year mortgage is calibrated for a 7 to 10-year cycle. It assumes mobility, it anticipates refinancing, and it profits most when borrowers behave exactly as they statistically do. They move, they refinance, they restart. The 30-year mortgage only benefits you, measured in total cost and equity accumulation, if you keep it for the full 30 years. Most people don't. Most people can't. Career shifts, family growth, market opportunities, divorce, relocation, life disrupts the plan. And every disruption resets the revenue stream for the lender while resetting your equity-building timeline. The product being sold isn't the house, it's the time. And time, structured this way, is exceptionally profitable.
30 years represents the prime span of your working life. If you sign at 30, you're free at 60. If you sign at 35, you're free at 65. That's your entire period of peak earning capacity, physical health, and cognitive sharpness devoted to one obligation. This has consequences beyond the ledger. Career decisions get filtered through the mortgage. Can you take the lower-paying job with better hours? Can you start the business? Can you go back to school? Can you take a sabbatical? The answer depends on whether the payment can be met. Risk tolerance compresses. Optionality narrows. Entrepreneurship declines among mortgaged households, not because ambition disappears, but because the steady paycheck becomes non-negotiable. The mortgage enforces stability. Stability often means staying in place, even when staying in place isn't optimal. Stress compounds. Studies show that housing cost burden correlates with mental health decline, marital strain, and sleep disruption. A $2,600 payment doesn't sound extreme until it's due every month for 360 consecutive months. Miss 3 and foreclosure proceedings begin. The consequences are severe. The pressure is constant. This isn't drama, it's documented. The mortgage becomes invisible psychological infrastructure. It shapes decisions you don't consciously attribute to it. It's the reason you don't quit, the reason you don't relocate, the reason you defer the risk. Debt doesn't only take money, it narrows your window of action. And the longer the debt runs, the longer that window stays narrow.
Here's another piece that often gets overlooked. You carry all the responsibilities of ownership, but you don't control the asset. You pay for repairs, you cover maintenance, you handle property taxes, you insure against damage, you absorb the cost of aging systems, failing roofs, broken HVAC units, foundation cracks. Every expense is yours. But miss enough payments, and the house isn't yours anymore. The bank exercises its security interest, foreclosure begins. The asset you've been maintaining and improving and paying taxes on gets sold, often at auction, often below market value. This is the legal structure. The mortgage gives the lender a secured claim against the property. You hold the title, but they hold a lien. You have legal ownership. They have financial control. And that distinction matters. Ownership implies independence, but a mortgage property isn't independent. It's leveraged. It's conditional. You're the occupant and the maintainer, but the lender is the lien holder with the power to repossess. For 3 decades, or however long the loan runs, you exist in this hybrid state, responsible for everything, in control of nothing unless the payment clears. This isn't an argument against homeownership. It's an argument for recognizing what a 30-year mortgage actually represents. So maybe the answer is shorter time. Maybe the 15-year mortgage is the responsible middle ground. It's shorter than 30. The interest is significantly lower, about $311,000 less in our example. The monthly cost is higher, but not prohibitively so for many households. It's better, no question, but it's not optimal. Here's why. Financial timing. Consider the life cycle cost of raising children. Stage 1, ages 0 to 5. Daycare, healthcare, basics. Expensive but relatively stable. Stage 2, ages 6 to 18. Education, extracurriculars, transportation, electronics, clothing, costs rise steadily. Stage 3, ages 18 and beyond. College, potentially graduate school, weddings, support during early adult independence. This is the spike. This is where families get financially crushed. Now map that against the mortgage timeline. If you purchase a home on a 30-year mortgage when your first child is born, that mortgage ends when they're 30 years old. You're paying off the house for their entire childhood, their entire adolescence, their entire college career, and into their late 20s. The mortgage obligation overlaps every expensive season of their life. With a 15-year mortgage, you're still making payments through their high school years and college. You're still carrying that fixed obligation when tuition bills arrive. The overlap is shorter, but it's still there during the worst of it. With a 10-year mortgage, you're done when they're 10, before high school, before college, before the costs explode. When the tuition bill comes, the housing payment doesn't. You've eliminated one major fixed cost exactly when you need liquidity most. The goal is not smaller payments. Smaller payments extend the obligation. The goal is aligning freedom with life's most expensive seasons. It's matching your financial structure to predictable life cycle events, not treating the mortgage as an isolated transaction. A 10-year mortgage doesn't just save $400,000. It repositions your household cash flow to absorb the costs that matter most when they matter most.
The 10-year mortgage isn't magic. It's discipline applied to a different set of assumptions. It starts with a larger down payment. Instead of the minimum, often 5% or 10%, you aim for 20% or more. This reduces the loan size and eliminates private mortgage insurance. It also signals to yourself that you're serious about paying this off fast. It continues with buying below your maximum approval. Lenders will approve you for a payment that maxes out your debt-to-income ratio. Ignore that number. Buy a house priced 20 to 30% below what you're approved for. This creates margin. Margin allows for aggressive principal payments without lifestyle destruction. It requires income growth to be directed intentionally. Every raise doesn't inflate lifestyle. Every bonus doesn't fund a vacation. Incremental earnings get routed to principal reduction. The goal is strategic compression, shortening the timeline faster than the amortization schedule assumes. It means avoiding lifestyle inflation. For a decade, you live more modestly than your income would allow. You drive older cars. You skip the kitchen remodel. You delay the boat. Delayed gratification applied systematically. Most people cannot move to a 10-year mortgage immediately. Income constraints, market pricing, life circumstances, all valid. But most people can shorten 30. A 30-year loan with an extra $500 per month toward principal becomes a 19-year loan. An extra $1,000 per month? 14 years. The math is accessible. The principle is this: time costs money. The faster you compress time, the more money you keep. Hundreds of thousands saved, decades of financial optionality gained. That's the trade. Short-term constraint for long-term freedom.
A mortgage is not evil. It's a tool. But like any tool, the way you use it determines the outcome. Time is expensive. The longer you stretch repayment, the more you pay. Ownership delayed is freedom delayed. Every year the loan runs is another year your cash flow is spoken for, another year your options are constrained. If you're going to own a home, own it deliberately.
Understand the full cost, not just the monthly payment. Understand the timeline, not just the approval amount. And if possible, own it fast. Subscribe for more breakdowns of financial systems that shape your life whether you notice them or not.